To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Friends, today we are going to learn about hire purchase and installment sale transactions. Let's take some simple examples to understand what these words mean. I think about 5 years ago, I went to a car showroom. I saw a car that was around 20 lakh rupees and I asked the shopkeeper, what is the price at which, what is the best deal that I can get? That person said, well, you can pay 20 lakh rupees and buy the car, option 1. Or you can pay 8 lakh rupees per year over 3 years. And at the end of 3 years, this car will become yours. Listen carefully. I have to pay 8 lakh rupees for 3 years. And then at the end of 3 years, the car becomes yours, is what the shopkeeper told me. The car dealer told me. Then I asked him a question. Hey, what if I pay money for 1 year, for some reason I am not able to pay money in the next year? What would happen? He said, sir, if you pay money for 1 year, if you don't pay money for the next year, that's it. Your money doesn't come back, we'll take the car back. Your money doesn't come back, but we'll take the car back. I pay money first year and second year, but third year, for some reason I am not able to pay the money. Then what would you do? I asked him. He said, sir, same thing. Whatever you paid remains paid. Nothing will come back to you. Car will come back to us, is what he told. Then I asked him, hey, what is this? Doesn't it sound unfair? In some way, I already paid, say even if I paid at the end of second year, I paid 8 more lakhs. So 8 lakhs plus 8 lakhs, 16 lakhs I already paid. In the third year, I'm not able to pay the balance 8 lakh rupees. Will you take the car back? He said, yes, there is no question. Then for 16 lakhs, whatever I paid, where is my ownership? I got angry because that definitely sounded unfair to me. He said, sir, tension kyun le rahe ho? Why are you getting psyched up and hyped up? He's like, whatever you paid is simply considered as rent. You use the car, right? So first year, second year, I will consider that as rent. Friends, this example, if you analyze in detail, you will understand everything that is required for the concept of hire purchase. Come on, now listen carefully. There is an asset. What is the asset? Car is the asset in this example, right? Next, that asset, the buyer can pay money and buy the asset. So I am the buyer. Say for a moment, you are the seller. Okay, you are the seller. You are the car dealer. You will sell the asset and I will buy the asset. So I need to pay you 20 lakh rupees today to buy the asset. That 20 lakh rupees is called as cash price of that asset. What is it called? Cash price of that asset, of the car. Cash price of the car. Now, 20 lakh rupees is the cash price of car. Does not mean I need to pay cash. That is, it's not a bank transfer. I have to pay cash. No, it's not. You shouldn't read in that language. Cash price means the money that I have to pay in total to get 100% ownership of the asset today. That is at the beginning of the transaction. What is the total sum of money that I need to pay, the buyer needs to pay to the seller to get 100% ownership of that asset at the day one without any further commitment to pay. That is what I mean. Okay. So in this transaction, there is no further commitment. If I pay 20 lakh rupees at the beginning of the transaction or the commencement of transaction, that asset is mine, that car is mine. That is what the car dealer told. So what do we call this 20 lakh rupees? We call it cash price of the asset. Okay, keep it aside. Then the shopkeeper gave me an alternative. What is alternative you gave me? You said, hey, alternatively, you can pay 8 lakh rupees for 3 years and then the car can become yours. Now, 8 lakh rupees for 3 years. There are two things here. 8 lakh rupees is the installment, hire purchase installment. What is this hire purchase? I forget that word. I'll just call it installment. Okay. So it is the installment that I need to pay. 8 lakh rupees is the installment I need to pay. Fine. Every year I need to pay 8 lakh rupees. Then over what period should I pay? I should pay it over 3 years. So every year I need to pay 8 lakh rupees and I need to pay like this for 3 years. The tenure of this agreement is 3 years. The term or the tenure of this arrangement is 3 years. So does it mean after 3 years I need to return the asset to you? No, that's not really what it means. In a hire purchase transaction, concentrate very carefully. The law says in a hire purchase transaction, the legal ownership of the asset gets transferred from the seller to the buyer on buyer paying the last installment. Now listen, let's just try to visualize it in this manner. Say this is the car, okay? This is the car. Now I have to pay 3 installments. I am dividing car into 3 parts, okay? Right. Now towards the end of the car, there is a strong handle. You are the seller. You held that handle, okay? You held that handle and waited. Now I am the buyer, right? So I paid 8 lakh rupees and said, come on car, come to me. Car can physically come to me, but the ownership of car, you're like, ownership of car is still, legal ownership of the car is still with me. Who is holding on to that? Seller is holding on to that. Then I pay the next 8 lakh rupees. So 8 lakh plus 8 lakh, 16 lakhs paid. Or more, the majority of the payment is made. The seller is like, I'm still holding on to the legal ownership of the car. You have not become the legal owner of the car. I took the car and I'm driving everywhere. But still, think about it. I am not the legal owner of the car. The seller, you are the legal owner of the car. Now, at the end of 3rd year, I paid the final installment of 8 lakhs. Then you will release the handle and say, now legal ownership is yours. You understand that? From the viewpoint of legal form of the transaction, only on payment of last installment, the legal ownership of the car will be transferred from the seller to buyer. Now what if in between, in the higher term of 3 years, what if the buyer dishonors a payment commitment? What if the buyer dishonors? Honoring payment commitment means paying that 8 lakh rupees as per the commitment. Dishonoring payment commitment means we pay one installment and then some other installments we default, we don't pay. That is what we mean by dishonoring the commitment. If the buyer dishonors the commitment, then in a hire purchase transaction, the seller can repossess the asset or repossess the goods. So what are the goods in this example? The goods are, the good is car. So the seller can take the car back. Okay, that is one. Second, the buyer and seller will simply agree upon that, hey, if we take the car back, the amount what you paid till now will be considered as hire charges, means rental charges for using the car. Now think about it, maybe the car has a life of 10 years, right? And we are just saying, oh, 8 lakhs paid in first year, 8 lakhs paid in second year, 16 lakhs rent. What? 16 lakhs rent. If I pay 8 more lakhs, then the car will be mine. Then pay, that's all. Then pay and use for 10 years, there is no problem. So the contract will be structured in such a way generally that the buyer ends up in a lot of occasions on the losing side when the contract is dishonored. Okay, so this is what you need to broadly understand regarding the concept of hire purchase. Let us talk about the concept of installment sale. We'll get an overview of these two, then we will start going into the depth of these transactions. In an installment sale, it is a little different. If you go to, say, electronic goods selling shop, these days, of course, with credit cards, it became a little easier, but earlier, these companies used to offer EMI options, where they say, hey, you want to buy a TV? Come, I'll offer this TV to you on installments. TV's price is 20,000 rupees. Every month you need to pay 2,000 rupees over 12 months and you can buy the TV, right? So that kind of transactions keep happening. So what exactly is the difference between hire purchase and installment? Say, I went to the shop, you are the shopkeeper, I came to your shop and I want to buy a TV. The price of TV is 20,000 rupees if I am ready to pay it upfront. There is an installment sale going on in your shop where if I pay 2,000 rupees, I can take the TV home. And every month I need to pay 2,000 rupees like this over 12 months, and 12 into 2, 24,000 is what I'll end up paying. But well, I still get the TV at the beginning of the first month itself. So I'm happy that, I'm getting my TV, I'm paying, yes, a little more, but I'm getting the TV. From your point of view, you're also happy, yeah, sure, take the TV. Now, what is the difference? If you look at the car example, 20 lakhs is the cash price of car. How much did we pay in total? 8 lakhs into 3, 24 lakhs we paid. Hare, 20 lakhs is the cash price. Why did we pay 24 lakhs? 24 lakhs minus 20 lakhs, that 4 lakhs is the interest what we paid on the car. Now come to TV. In TV, what is happening? 20,000 rupees is the price of TV. If I pay that money upfront, it is only 20,000 rupees. But I asked for an installment. Because I asked for an installment, the shopkeeper said, sure, pay me 2,000 rupees a month. Over what? Over 12 months time. So 24,000 you pay. So 24,000 minus 20,000, that 4,000 is also interest which the buyer is paying, the seller is collecting. Yes or no? In both the cases you find that to be similar. There is interest portion which the buyer is paying, the seller is collecting. That's happening. Now, the main difference is at the end of first month, I paid first 2,000 rupees and took the TV. At the end of first month, I got a call, hey, you have to pay tomorrow next 2,000 rupees. I say, I'm not interested in paying 2,000 rupees. Come and take your TV back. In installment sale, the assets risk and reward, basically the legal ownership will be transferred at the beginning of transaction, where the shopkeeper will say, I will come and sell off other things at your home and take my money and go. Not just coming and taking the TV back. I'll sell off some other items at your home, I'll take my money back. You have to pay me money. It is not simply take the TV and go. No, it doesn't work like that. So in an installment sale, the risk and reward, even in a legal manner, who became the owner the moment I paid 2,000 rupees and get the TV? Yes, I gave a commitment to pay the balance, 2,000 into 11. Yes, I gave that commitment. But who became the owner? I became the owner already. Hare, I paid only 2,000 rupees. Yes, you paid 2,000. I paid 2,000 rupees, but still I become the owner. Alright, so in installment sale, even legally, the ownership gets transferred to the buyer. Now, there is a super duper important point we are going to discuss now. Please pay utmost attention. There is paragraph 5 of Accounting Standard 19, which talks about a beautiful point. It says, hey, legally you can say, in case of hire purchase, only on the payment of last installment, the risk and reward is transferred. In case of installment sale, the moment you enter into transaction, risk and reward is transferred. All that for legal purpose is okay. But if you look at in accounting, substance over legal form. Substance over legal form means what? If you look at the essence of transaction, once somebody takes a car, buys a car on hire purchase basis, generally they will do whatever possible to make that payment, because if after paying a couple of installments, if I don't pay, I know that I lose a lot. So generally they get honored. So it's like, why do you want to do all these things? In essence, substance over legal form, the accounting standard says that this should be treated, even if it is a hire purchase transaction, from seller's point of view, treat it as a sale the moment the transaction is entered into. From buyer's point of view, treat it as if it is an asset purchased. The moment you enter into transaction, not necessarily at the end of third year. Understand that? So, at the beginning of first year itself, the buyer will recognize this as an asset, seller will recognize this as an item sold. Okay? So, buyer will say, I bought it. Seller is saying, I sold it. When? At the beginning of first year, not at the end of third year, even though legally the ownership transfer happens only at the end of third year. Friends, legal ownership might get transferred at the end of third year in case of hire purchase, but for accounting purpose we are saying, in essence, in reality. So reality over legality. Accounting standard 1 also talks about it. Whenever you are doing accounting, you have to bear this point in mind. Substance over legal form. Reality of transaction over the legality of transaction. So you clearly see that this transaction should be considered as one where the risk and reward got transferred upfront, means at the beginning of first year, not necessarily at the end of third year. In case of installment sale, anyway, that is what the law also says. So whether it is hire purchase or installment sale, the point to bear in mind is the moment the transaction is entered into, for accounting purpose, purely for accounting purpose. Legal purpose I already told you. As per law, in hire purchase, only on the payment of last installment, the risk and reward gets transferred. Risk and reward means what? Risk and reward incidental to ownership, meaning the kind of legal transfer of ownership happens in hire purchase on the payment of last installment. In the case of installment sale, the moment contract is entered into. But for the purpose of accounting, there is no difference like this. The moment the transaction is entered into, substance over legal form, you will treat as if the seller sold it and the buyer bought it. Alright? I hope whatever we learned till now is clear. Now let us go back to that example of car. The cash down price of car is 20 lakh rupees. But if you look at the hire purchase price, what is the hire purchase price? 8 lakhs into 3, 24 lakhs is the hire purchase price of the car. 24 lakhs minus 20 lakhs, that 4 lakhs is what we call as interest. 4 lakhs is called as interest. In other words, the seller of car is basically doing two works here. One work is that of a seller and the other work is that of a money lender. Think about it. Say you are the seller of the car. There is a third party called State Bank of India. You are the seller, I am the buyer, there is State Bank of India. You want 20 lakhs, I have to pay 20 lakhs, I don't have 20 lakhs. I went to State Bank of India, asked bank for 20 lakhs, took a loan. Okay, margin money I have to pay and all, just forget that. So I took a loan and then I gave that money to you, you gave the car to me, and then I will keep paying installments to State Bank of India. Correct or not? That is what would happen if there is a banker in between. But what is the role that you are playing now? You are playing the role of a car seller plus banker. You are playing the role of a car seller plus banker. So what you are essentially doing is, by selling the car to me on credit basis, when I have to pay 8 into 3, 24 lakhs, in your head you clearly know, oh, had I sold this car only for cash down price, I would have gotten only 20 lakhs. But I am getting extra 4 lakhs. That extra 4 lakhs is because of what? It is because of interest factor, right? Now, from my point of view, I also feel the same. 20 lakhs I should have paid, but I am paying extra 4 lakhs because that 4 lakhs is interest. So now, concentrate carefully. In your books, you are the seller, I am the buyer. Now, in your books, you should record 20 lakhs as the selling price. I should record 20 lakhs as the purchase price. You should consider interest income for 4 lakhs. I should consider interest expense for 4 lakhs. When should 20 lakhs be considered as sale in your books? You should consider 20 lakhs as sale in your books when the transaction is entered into. The risk and reward in the transaction, when it is passed, you should record this as sale. Similarly, I should record this as purchase when the risk and reward got transferred to me. When did the risk and reward get transferred to me? Substance over legal form. The day we enter into transaction, risk and reward gets transferred to me. Alright? So, I should record the asset or the item purchased at its cash price. You should record the item sold at its cash price when when the risk and reward got transferred. Means the transaction is entered, the date when transaction is entered into. Now the next point, what about interest? So 20 lakhs we figured out. What about interest? Interest is something which accrues on time proportion. Interest accrues on time proportion. So friends, now if you look at that 24 lakhs, that 24 lakhs has two parts, 20 lakhs part and 4 lakhs part. 20 lakhs is basically the cash price, what we are calling. That cash price, as a buyer seller we are calling it cash price. Now you come into the next position what you and I have, that is the money lender and the loan taker. So because you are giving this asset to me on hire purchase basis, I am paying this money over a period of time. You are the money lender. You are playing the role of SBI also now. So you are the money lender, I am the borrower. What is the money you lent to me? You lent, listen carefully, you lent not 24 lakhs, 20 lakhs to me. You lent 20 lakhs to me. As I repay the 20 lakhs, I need to pay an extra 4 lakh rupees to you as interest over 3 years time. You lent to me how much? You lent to me the cash price of asset. You lent to me the cash price of asset. Friends, I'll repeat, this is very important. If you get this logic, then this chapter becomes super simple. You are the seller, I am the buyer. There is State Bank of India. For a moment say, I am bringing State Bank of India back into picture. State Bank of India is giving a loan to me. 20 lakhs loan State Bank of India gave me. That 20 lakh rupees I gave to you. You gave me the car. Alright? I got the car by paying how much? 20 lakhs. You are the seller. How much did I pay the seller? 20 lakh rupees is what I paid the seller. Keep it aside. How much loan did I take from State Bank of India? I took a loan of 20 lakhs from State Bank of India to give to the seller 20 lakh rupees. No big deal. It's obvious, right? It's common sense. Now, listen carefully. State Bank of India's 20 lakhs loan, I need to pay over 3 years. Say, I need to pay over 3 years. At the end of first year, I need to pay 8 lakhs. At the end of second year, 8 lakhs. At the end of third year also, 8 lakhs. Okay, right. In every installment of 8 lakhs what I pay, there is principal portion, there is interest portion. Correct or not? Of course. In total 24 lakhs, 20 lakhs is the principal, 4 lakhs is the interest. So, if you break it down into 8 lakhs, 8 lakhs, 8 lakhs, in every 8 lakh rupees of installment, there will be some principal portion, some interest portion, naturally. And in the first year, from that point of view now if you see, in the first year, State Bank of India may tell me, hey, 20 lakhs is the loan I gave. On 20 lakhs, interest will be charged in the first year. Okay, right. At the end of first year, I paid 8 lakhs. In that 8 lakhs, there is principal, there is interest also. But remember, once I pay 8 lakh rupees to State Bank of India, my principal portion also will come down. Correct or not? Because in 8 lakhs, what I paid to State Bank of India, I paid some portion towards principal, some portion towards interest. After that, in the second year, the amount of loan outstanding will come down. On that, there will be interest. Like this, it will gradually, interest amount will keep reducing as I keep paying the principal. Is this point simple enough? As I keep paying the principal, the interest portion keeps coming down. Okay. Now, my dear friends, when you are playing the role of seller come banker, when you are playing the role, if you are a hire vendor, you are playing the role of a seller plus banker. Okay, if I am a hire purchaser, I am playing the role of a buyer plus borrower. Buyer plus borrower. Friends, it's very important for us to get this point right, because you know, in the books of hire vendor, means that seller, you will pass some entries in the capacity of a money lender. You will say, sell as a seller, I sold an asset. Then you will say, oh, I am getting interest income. Interest income also you will record. Why? You are a money lender, right? When I am paying money to you, you are saying, my installment, whatever I am supposed to receive, that principal is reduced. So basically, you are playing the role of a seller plus money lender. Now, think from my point of view, I am the hire purchaser. Hire purchaser will say, hey, I am a buyer, right? Purchaser. When I purchased, say this is an asset, this is a fixed asset for me. If it is a fixed asset, then, oh, I purchased a fixed asset. Very good. So, purchase of fixed asset entry I will write, okay? After that, because it is a fixed asset what I purchased, I will charge depreciation also, right? Then, the depreciation will go into P&L account also. Then, because I am a borrower, I need to pay principal plus interest, right? It's not just interest, I need to pay principal plus interest. So, I will be paying these as I pay these loans, the amount what I need to pay you in the capacity of the banker and borrower, that amount will slowly start going down, okay? So, this is what will typically happen in case of a hire purchase transaction. So, friends, the hire vendor is playing two roles. Hire purchaser is also playing two roles. Hire vendor is playing the role of a banker and a seller. Hire purchaser is playing two roles, buyer and borrower. If these points are clear in your head, accounting entries will become super simple. We'll take up one small problem. We will understand the application of this concept in that problem. Now, let us read this question. Asha purchased a truck on hire purchase system. So, whose books are we talking about? Buyer's books. Okay. Then, as per the system, as per the terms, he is required to pay 70,000 down, 53,000 at the end of first year, 49,000 at the end of second year, 55,000 at the end of third year. Okay. Now, what I will do is I will just draw a timeline so that whatever is given in the question we understand clearly. Year 0, year 1, year 2, year 3. What is the down payment? Down payment is 70,000. At the end of year 1, 53,000. Year 2, 49,000. Year 3, 55,000. Interest is charged at 10%. Fine. You are required to calculate the total cash price of the truck and interest paid with each installment. So, if you see very clearly, all put together, you get the hire purchase price. What is the hire purchase price? 70,000. Let us just quickly do the calculation for that. 70,000 plus 53,000 plus 49,000 plus 55,000. 2,27,000 is the hire, what is that? Hire purchase price. Okay, I will call it HP price, hire purchase price. My dear friends, this has two components, interest component, principal component. What is the principal component? I don't know. What is the interest component? I don't know. But what is the clue you have? 10% per annum is the interest. That is what we know. So, what we will do is, based on this information, we will try to decode and arrive at what is the principal portion in this and what is the interest portion in this. So, look at how we are going to approach this. Now, friends, in this 55,000, which is the third year's installment, there is principal portion, interest portion, right? Now, here this is how it is supposed to be done. 55,000 is total what we are paying. Now, if you break this up, in 55,000, there is a principal portion, interest portion. What is the interest? Interest is 10 rupees. Interest is 10 rupees. Principal is 100 rupees. There is no further principal. This is the last installment. So, principal is 100 rupees. So, the 55,000 rupees of amount paid is comparable to 110. Think about it. We paid 55,000. In that, there is principal, there is interest. If the principal, balance left out, okay, balance payable, if it is 100 rupees, then on that interest is 10 rupees. So, imagine at the beginning of third year, 100 rupees was the principal payable. On 100 rupees, you are saying 10 rupees is the interest. So, 100 plus 10, 110 is what this 55,000 represents. We will make a working note to understand this. Working note 1. 55,000 represents, this is installment, year 3, right? This represents principal, interest. Principal when? Principal outstanding since the beginning of third year. Because when did principal payment last happen? At the end of second year it happened. At the beginning of third year there was a portion of principal. So principal plus interest. If this were 100, 10 rupees is the interest. Means this 55,000 represents 110. Now we are trying to calculate this way. If 110 is represented by 55,000, 100 is how much? 10, how much? Very simple, cross multiplication. 100 into 55,000 by 110, which is 50,000, and interest is 5,000. Interest is 5,000. Beautiful. So in year 3, out of 55,000, you understood that the principal is 50,000 and interest is 5,000. Let us apply that logic further. Look at the installment that was paid in year 2. At the end of year 2, 49,000 is what was paid. Okay. Now pay attention. Say we are at this point, year 2, at the end of year 2. We paid 49,000. Okay. We paid 49,000. After we paid 49,000, still how much principal remained outstanding at the end of year 2? After we paid 49,000 of installment, how much principal remained outstanding? The principal which remained outstanding, which we got from working note 1, is 50,000. Correct or not? 50,000 remained outstanding after paying 49,000. Meaning, before paying this 49,000, what was the amount outstanding? The amount that was outstanding was 49,000 plus 50,000, 99,000 is the amount that was outstanding before you paid this 49,000. So this is how it looked. Come to working note 2. Working note 2. End of year 2. Okay. Before paying 49,000, before paying 49,000, 49,000 plus this 50,000, totally 99,000 would have been outstanding. 99,000 would have been outstanding. In that 99,000, again we will apply this principle. This must be equivalent to or comparable to 110. What is 100? What is 10? We are trying to break it up. Now listen carefully. The breakup is, if 110 is represented by 99,000, 100 how much? 10 how much? This will be 90,000. This will be 9,000. Okay. That is a simple cross multiplication you will do and arrive at. Now the important point is, this is the principal, this is the interest. Interest of 9,000 actually was paid as a part of 49,000. But if you break down this 90,000, if you break down this 90,000, in this 90,000, concentrate, 50,000 was paid when? Was paid in year 3. It was paid in year 3, not in year 2. Then Out of 49,000 paid, 9,000 went towards interest. 50,000 basically we are saying that was paid in year 3, that is not paid in year 2. So 40,000 is what is the principal payment for year 2. Principal paid in year 2 is 49,000. So 40,000. Principal paid in year 2 is 40,000. So friends, if you look at this 49,000, this 49,000 now got two parts, 40,000, 9,000. Okay, 40,000 is paid towards the principal in year 2, 9,000 is paid towards interest in year 2. So let us highlight what is the principal paid in year 3. 50,000 is the principal paid in year 3. Interest is 5,000. In year 2, principal paid is 40,000. Interest paid is 9,000. In similar manner, let us go to year 1. Working note 3. In year 1, actually the question says 53,000 was what was paid in year 1. Before paying 53,000, balance outstanding at year 1 end is equal to 53,000 plus what? 53,000 plus 90,000 cumulative principal. Go back to this. You find that cumulatively 90,000 was outstanding at the beginning of year 2. On that, 10% interest was considered, means 9,000 rupees of interest was considered. So 90,000 plus 9,000, 99,000 was outstanding. Out of 99,000, we said interest we will pay 9,000. Out of 90,000 of principal, we paid only 40,000 in year 2. 50,000 we said we will talk about that in year 3. Okay. So at the end of first year, 53,000 was paid. After paying 53,000, still 90,000 of principal was outstanding. So before paying 53,000 rupees of installment at the end of year 1, how much was the amount outstanding? Look at this. 1,43,000 was the amount which was outstanding. Now again, break this up. This is 110. What will be 100? What will be 10? Okay. If 110 is represented by 1,43,000, 10 is how much? 100, how much? Cross multiplication, 100 into 143,000 by 110, which will be 1,30,000. If you know 13 table, you will understand this. Then this is 13,000. Okay. Now, in this 1,30,000, we know very clearly in year 3, 50,000 we paid. In year 2, 40,000 we paid. In year 1, how much was paid? In year 1, balancing figure, the amount would have been 40,000. Amount would have been 40,000. So, this is the breakup. 40,000 of principal actually got repaid in year 1, 40,000 in year 2, 50,000 in year 3. Okay, this is how amounts were paid. Okay, now you have this calculation. Now we will go back to the timeline. We will draw a fresh timeline and place all these important numbers into the timeline. You will clearly understand what is the cash price of the asset and the interest that we paid on the asset. Year 0, year 1, year 2, year 3. So friends, in terms of principal, year 0, we paid how much upfront? 70,000. There is no interest portion in this. Upfront payment means in that where is the interest portion? Okay, we paid 70,000. Then what is the interest we paid? Nothing. Installment 70,000. Okay, right. Year 1, we paid an installment of 53,000. In that 53,000, just now we calculated 13,000 is the interest, 40,000 is the principal. In year 2, 49,000 is the installment. In that 9,000 is the interest and 40,000 is the principal. Then finally we paid 55,000. In that 5,000 is the interest, 50,000 is the principal. Friends, if the question asks you what is the cash price of the asset, very simple, take these numbers, 70,000 plus 40,000 plus 40,000 plus 50,000. So please write cash price is equal to 70,000 plus 40,000 plus 40,000 plus 50,000, which is 2 lakh rupees. Okay, then interest is equal to, again total up, 0 plus 13,000 plus 9,000 plus 5,000, which will be 27,000. Okay. So this is how you are supposed to solve this problem. We will practice more problems, then you will feel more comfortable. This is the first time you would have probably solved a problem like this. Just try understanding the logic of what we tried doing. As we solve more problems, you will definitely get much more comfortable with this concept. Now let us look at the next problem. A acquired on 1st Jan 2000 X1 a machine under a hire purchase agreement which provides for 5 half-yearly installments of 6,000 each, the first installment being due on 1st July 2000 X1. Assuming that applicable rate of interest is 10% per annum, calculate the cash value of the machine. All workings should form part of the answer. Now, let's analyze this carefully. What is the beginning date? The beginning date is 1st Jan 2000 X1, right? Then, this is under hire purchase agreement for 5 half-yearly installments. So, there are 5 installments and the first installment is due on 1st July. 1, 2, 3, 4, 5. 1st July 2000 X1 is when the first installment is due, right? And then because these are half yearly, the next one must be then, right? So we have 5 installments, half yearly installments due. Assuming that applicable rate of interest is 10% per annum. So annualized rate is 10%, 5% is the half year's rate. So you can say 5% per half year. Because these are half yearly cycles, you need to consider the half year's interest. Acha, each installment is 6,000. Okay. So 6,000, 6,000, 6,000, 6,000. Okay. Now we need to calculate the cash value of machine. So how do we calculate the cash value of machine? In fact, in the previous problem also, we have seen how cash value of a machine or an asset can be calculated. Let us apply a similar logic here. Look at this. There is this 5th installment. 5th installment is for 6,000. Okay, right. Now in this period, the interest rate that got added would have been 5%, 6 months, right? So 5%. So here is the point. 6,000 is the last installment. After paying 6,000 rupees, the account is fully settled, right? So in other words, in that 6,000 rupees of installment, there are 2 portions, principal portion, interest portion. What is the interest portion? If 5 is the interest portion, 100 is the principal portion, which means this represents 105. Alright. Now, if this represents 105, then let us calculate what principal works out to and interest works out to? 100 into 6000 by 105. It will be 5714. Alright, and the balance is what? 286. Balance 6000 minus 5714. 286 is the interest portion. Alright. So friends, basically what we have done is we have done a simple cross multiplication. If 110 is represented by 6000, 100 is how much? 5 is how much? That is the kind of cross multiplication we have done. Alright. Now like this we will work backwards the way we have done in the previous problem and arrive at the cash value of asset. So this calculation let us do in a working note. Working note 1. Fifth installment. What is the fifth installment? 6,000 rupees. 6,000 rupees is the installment. This contains principal and interest, right? Now the principal portion, if it is 100, interest is 5. When you say 5% per half year, if 100 is the principal, 5 is the interest. So principal plus interest, this represents 105. Makes sense? Alright. Now what we are basically saying is if 105 is represented by 6,000, 100 is represented by how much? Similarly, if 105 is represented by 6,000, 5 is represented by how much? So as we calculated, 5714 is the principal portion and interest portion is 286. Alright. Now let us move into working note 2. Working note 2 is for the fourth installment. Now, what is the fourth installment? Fourth installment is 6,000. Alright. After paying 6,000, still how much was the principal outstanding? The amount which was paid in the fifth installment is the amount which was outstanding. Add principal outstanding. Working note 1. 5714. Okay. Add that. It comes to 11,714. 11,714 is the amount outstanding before fourth installment payment. Okay, this is the amount outstanding before fourth installment payment. Now the point again is, in this there will be a principal portion and interest portion. If interest is 5, principal will be 100, this will be 105. If 105 is represented by 11,714, 100 is represented by how much? 5 is represented by how much? We will do a cross multiplication. 11,714 into 100 by 105. That is 11,157. Okay. And this is 11,714. So this is 558. Now basically what we are saying is, in the 6,000 rupees, definitely 558, this is the fourth installment, okay. So 558 of interest is paid. So how much is paid towards principal portion is the question. 5,442 is what is paid towards the principal portion in fourth installment. This is the interest that is paid in the fourth installment. Are we clear about the fourth installment calculation? Now let us move to the third one. Now let us come to working note 3. This is for the third installment. Look at the third installment. Third installment amount. Amount of third installment is 6,000. Even after paying third installment, still there is principal outstanding. Add principal outstanding after third installment. This is coming from working note 2, of course partly from working note 1 and also from working note 2. This is 5714 plus 5442. So this comes to 11,157. Now total will be 17,157. 17,157 is the outstanding amount before paying that 6,000. Before paying third installment outstanding amount. Now, the point is in this, if this is 105, you want to know what is 5. Basically, I want to know the interest portion. Okay. So, what will be the interest portion? 5 by 105 into 17,157. 817 is the interest portion. If 817 is the interest portion, now go to the calculation. In that 6,000 installment, you will give a breakup now. In the 6,000 of installment, you will say 817 is the interest and what is the balance? 5183 is the principal. Now friends, just for us to be clear, in 17,157, when you said 817 is the interest, it basically meant 16,340 is what needs to be paid towards principal. How did this 16,340 get paid? Something was paid in the third installment, something in the fourth installment, something in the fifth installment, right? So, in the fifth installment, how much was paid? 5714, then 5442, 5183. From this calculation I am just writing. So basically this way you know the breakup of what that comprises. Of course, you know that is an optional calculation. You don't have to really give a breakup of 16,340. I just gave it for your understanding because before paying third installment means third installment, fourth installment, fifth installment. So in the third installment, there will be some portion towards the principal repayment, some portion towards interest. How much portion is towards interest? For us to calculate that, basically we did this working where in 17,157, we said, hey, 5 rupees is the interest, 100 rupees is the principal, this is representing 105. So then what is 5 representing? We arrived at the interest portion. So that is where we said the balance amount of 5183 is the principal. Alright, now let us go to the second installment. We will make working note 4 for it. Second installment. Again, installment, second installment 6,000, principal outstanding after second installment. Just now you saw 16,340, right? Then that is whatever was repaid in the third, fourth and fifth installments put together, right? Outstanding before paying second installment. That will be 22,340. If this is representing 105, 5 is how much? That is the interest portion. So 5 by 105 into 22,340, which is 1064 minus 22,340, 21,276. That is the principal cumulatively paid in second installment, third installment, fourth installment, fifth installment. So in this, just for our understanding, how much is paid in second installment I don't know, but I know that third plus fourth plus fifth put together is 16,340. Okay, right. Anyway, this way also you can find out the second installment amount. It will be 21,276 minus 16,340, which is 4936. Okay, so this is one way in which you can find out the principal. This is the principal, right? Repayment. This is the interest payment. Now 4936 can be arrived at in another way, which we already saw. In 6,000 rupees of second installment, 1064 is going towards interest. Principal. So this is second installment, right? Principal is how much? 4936. This is the principal which was paid along with the second installment. Now let us come to the first installment. Working note 5. First installment. Now, amount of first installment 6,000, then principal outstanding after paying first installment just now you saw in working note 4 21,276. 21,276 plus this is 6,000. 27,276. This is amount outstanding before paying first installment. Okay. All right. Now this is the amount outstanding before paying the first installment. In this, if this is represented by 105, what is 5? 1299 is the interest portion. Okay. Then what is the principal? $25,977 is the principal. This is the cumulative principal that has to be paid. In first installment, how much of the principal should be paid? Second plus third plus fourth plus fifth, how much should be paid? This is 21,276. We already calculated that. So 21,276. So this will be 4701. What is the other way to arrive at this 4701? In 6,000 rupees of first installment, this is just an alternative way. You know that 1299 is the interest. So, what is the principal 6,000 minus 1299? 4701. So, this is the principal. Now, let's put together the different numbers what we got from workings and arrive at the cost of asset, that is the cash price of asset. You can call it solution. Cash price of the asset. Okay. All the principal repayments which we had. Second, third, fourth, fifth. We repaid 4701, 4937, 5183, 5442, 5714, all put together 25,977 is the cash price. Friends, is it making sense? 25,977 is the cash price of the asset. That's all. This is what we are supposed to calculate. Are we asked to calculate the interest amount also? No, that's all. So, this is what you are supposed to calculate, and this we calculated. This came from working note 5, working note 4, working note 3, working note 2, working note 1. Of course, I know when we did our working note 5, in that working note, when we looked at the total principal which was repaid, we saw the total principal which was repaid was 25,977. Where did we see? In this calculation, we found if the total amount outstanding before paying first installment is 27,276, when we found that interest is 1299, when the balance is the total principal paid, that came to 25,977, we said there is some amount which would have been paid along with the first installment, other amounts with the other installments. These other installment amounts you had, first installment amount you calculated, all that is fine. But by the way, this number we got even without doing the totaling, it was already there in our working note. But for presentation purpose, I am giving clearly for in each installment how much is paid towards principal repayment. Now friends, let's look at the next question. On 1st April 2000X1, a manufacturing company buys on hire purchase system a machinery for 90,000 payable by 3 equal annual installments combining principal and interest. The rate of interest was 5% per annum. Calculate the amount of cash price and interest. Assume that the present value of annuity of 1 rupee for 3 years at 5% interest is 2.723. Okay. This question is asking us to apply a simpler way to get that answer. Look at what the question says. Manufacturing company buys on hire purchase system a machinery for 90,000. So basically each hire installment is 90,000 payable by 3 equal annual installments combining principal and interest. So in 90,000 there is principal, there is interest, that is 30,000 per year. So in that there is principal as well as interest. In one of the earlier problems that we have done, in that 6,000 we said there is principal, there is interest. The same way here in 90,000 total, and even in the 30,000 per annum there is principal and interest. Okay, 5% per annum, these payments are annually, and 5% per annum is the interest. Calculate the amount of cash price and interest. Assume that present value of annuity of 1 rupee for 3 years is at 5% is 2.723. Okay. Now friends, there is an amount which is paid at the end of every year, 30,000, 30,000, 30,000, right? Now we want to know the present value of that. What is asked in the question? Cash price. What is the meaning of cash price? Cash price is today's value of asset if the entire money is paid off in one shot and the asset is purchased. Let us see how we can apply this concept of annuity and solve this problem. Now look at this. Say this is when we purchase the asset. Year 1, year 2, year 3. 30,000, 30,000, 30,000. Okay, right. Now imagine, concentrate very carefully. Okay, imagine there is an amount of 100. There is an amount of 100 and we want to find the present value of 100. We want to find what? Present value of 100. What do we mean by that? 100 is the value at the end of 1 year. 5% is the interest rate. 5% is the interest rate. If 5% is the interest rate, we are saying today as if we deposit some money at 5% growth, it becomes 100 at the end of first year. So it is something like this. I don't know what that x is. X, okay, plus 5% of x is equal to 100. Okay, right. In other words, if I take x common, 1 plus 5% of x is 5 by 100 of x, 100, x into 1.05 is equal to 100, implies x is equal to 100 into 1 by 1.05. Understood? 100 into 1 by 1.05 will give us the present value. What is that coming to? 95.24. So simply, if you ask me, if 100 rupees is paid at the end of first year, if 5% is the interest rate, what is the cash price of asset? I will say that cash price of asset is 95.24. Okay, right. Now, if the year 2 number, now if I am talking about this, how many cycles should this run? This should run 2 cycles. Okay, so then what I will say is x is equal to 100 into 1 by 1.05 whole square. Okay, means 2 times that cycle is running. Then if it is for this cycle where I say 3 cycles it is running, I will write x is equal to 100 into 1 by 1.05 whole cube. 3 cycles it is running. Now basically if you look at the calculation, it is something like this. It is not 100, it is 30,000. Okay, instead of 100 it is 30,000. So we are basically saying 30,000 into 1 by 1.05 to the power of 1 plus 30,000 into 1 by 1.05 to the power of 2. Meaning for this 30,000, this number, for this 30,000, this number, plus 30,000 into 1 by 1.05 whole cube. For this 30,000, it is this number. If I take 30,000 common, it is 1 by 1.05 to the power of 1 plus 1 by 1.05 whole square plus 1 by 1.05 whole cube. Okay? Friends, this is what we call as present value factor. Each of these is called present value factors. Present value factors. Okay? Total of those present value factors is called present value annuity factor. PVF we call it present value annuity factor. Why am I able to apply this annuity factor? Because installment everywhere is constant. Because installment is constant, applying simple rule of mathematics, I am taking that amount 30,000 common and then saying, instead of saying 30,000 into 1 by 1.05 to the power of 1 and so on, all I am doing is I am taking 30,000 out as a common number and saying 1 by 1.05 to the power of 1 plus 1 by 1.05 to the power of 2 plus 1 by 1.05 to the power of 3. So, the total here what you get, we can call it as PVAF. This total of these present value factors we call as PVAF, 5%, 3 years or 3 cycles, that is what we mean, 3 cycles. Okay, now this number is given in the question. This number you can calculate also, there is no rocket science in this. 1 by 1.05 to the power of 1, you can calculate what that is, and 1 by 1.05 whole square what it is you can calculate. You can arrive at that, but in the question it is already given to you. It is 2.723. 30,000 into 2.723, that is the present value annuity factor. Okay? Okay. How much will that come to? 30,000 into 2.723, 81,690. Okay? This is the cash price of asset, meaning today itself if the entire amount is paid, then 81,690 is what should be paid. Friends, did you understand this? So, in other words, instead of having 81,690 paid upfront, we are saying 30,000, 30,000, 30,000 you pay over 3 years, because we considered in each installment 5% of interest per annum. Because we considered 5% of interest per annum, we are saying that's fine. So, now by applying present value annuity factor, you got 81,690. Friends, the same problem what we solved, we could have solved in the way in which we solved the earlier problems, where in the last installment of 30,000, you could have said, because the interest rate is 5%, you could have said that 30,000 is comparable to 105. In that, you arrive at what is the 100 and what is 5. And based on that, you kind of go to year 2 and then you come to year 1. You know, we solve problems, the first 2 problems we solved in that manner. So, we can solve it that way, but you know very well that that is a long and a detailed process. If you know the present value factors and present value annuity factors, particularly when the installment is equal, it will be very easy for us to apply the method that we solved in this problem. But when will this work? When the installment is equal. When the installment is equal, present value annuity factor can be applied. So, you can just apply that and you will get all that calculation we used to do. Year 3, you split the principal and interest portion, then you come to year 2, then you get the principal. I mean, you kind of add that up and say, oh, this amount of principal repaid in year 3 would have been outstanding at the end of year 2 before paying the
30,000 of installment, and then you gross it up and break that down into what is the interest and principal, and based on that you go to year 1. So that is a much more elaborate way to solve this problem. But well, you can cross check that. If you want to try, you can try it out. You will arrive at the same answer. Alright? Friends, now let's move on to the next problem. So here we will find out the interest amount. Om Limited purchased a machine on hire purchase basis from Kumar Machinery Company Limited on the following terms. Cash price 80,000. Down payment at the time of signing the agreement on 1/1/2000 21,622. 5 annual installments of 15,400, the first to commence at the end of 12 months from the date of down payment. Rate of interest is 10% per annum. You are required to calculate the total interest and interest included in cash installment. Wonderful. So how do we solve this problem? So here look at this. So we have in the information given, we have cash price. What do you mean by cash price? The value of asset if we were to purchase it right now without any installments is 80,000. Okay. So what you know based on this is down payment plus all the principals that were paid. If you bring them to present value, that amount should be 80,000. Okay, continue further. Down payment, I know some of you must be like, sir, what did you speak just now? We didn't understand. Don't worry, you will understand when I solve the problem. Down payment at the time of signing the agreement on 1/1/2000 is given to you. Okay, then 5 annual installments. So down payment is given, annual installments are given, and the first installment will start at the end of 12 months from down payment. Rate of interest is also given. Okay. So friends, let us put a timeline, let us draw a timeline, and then we will be in a better position to solve this problem. Now let us put the information given in the question on this timeline. Year 0, year 1, 2, 3, 4, 5. That's what the question says. Cash price 80,000. Cash price is not down payment, right? So down payment was paid 21,622. That was paid. Then 15,400 equal installments. Okay, right. These are the amounts which are paid, outflows. Then interest is 10% per annum. And present value, basically the cash price, rupees 80,000. Okay, now concentrate carefully. What sense do we make out of this? 80,000 is the cash price. But out of that cash price, what is collected upfront as down payment? 21,622 has been collected as down payment upfront, right? So I tell you that, hey, this is worth 80,000 and you pay me 21,622 right away at this point. So to that extent, there will not be any interest, right? So that's already paid and settled off. Only for the balance, there can be interest. Why? Because that amount was paid over a period of 5 years. On that there can be interest. So let us write down cash price minus DP. Cash price minus DP. What is cash price minus DP? This will be 58,378. So the 80,000 minus 21,622. So 58,378 is the value of asset. Listen carefully. Is the value of asset which is paid in the form of 5 installments. That's what the question says. 5 annual installments of 15,400 in which interest rate was 10%. Okay. Now one simple rule. Interest will be charged on what amount? If I just see it from this lens, say we took a loan from a bank for 58,378 rupees. At year 0, we took a loan from bank for 58,378 rupees. Interest rate is 10%. Interest rate is 10%. So, in the first year, there is no payment made. At the end of first year, only payment is made. So, for first year, how much interest should be charged? 10% of the outstanding amount. Outstanding amount is what? 58,378. 10% of 58,378 should be the interest amount. Yes or no? Then, after considering the interest amount, you will arrive at the amount which was paid off in the form of principal. Okay? Right. So, we will put this neatly in the form of a table. In the table, you will clearly understand what is missing, what is given. Based on that interest amount, we can easily calculate. I took opening balance, interest at the rate of 10%, then installment, then principal repaid, okay, then closing balance. Right. Listen carefully. What is the opening? What are the things which you already know? Opening balance. At the start itself, you know that opening balance for year 1 is 58,378. That is the opening balance. Alright? Because that 21,622 is already paid off. So, there is no loan interest on that. Then, what is the other thing which is known to you? Installment every year end. Installment at year end I will write. Installment at year end is 15,400 in all the cases. Alright. Principal repaid, if I just kind of give some coding to this column is A, this column is B, this column is C, then principal repaid will be D, which is C minus B. Clear? C minus B is the principal repaid. Then closing balance, I will call it E, which is opening balance minus principal repaid. Okay, right. We just gave some references so that we know how we are calculating this. Now, calculate interest for first year. Interest for first year, 10% of 58,378 will be 5838. Straightforward. Now, principal repaid. What will be the principal repaid? We already understood. C minus B. So, calculate 15,400 minus 5838, which is 9562. That is the principal repaid in that installment. Now come to closing balance. What is the closing balance? 58,378 minus 9562. That is the closing balance, which is 48,816. Okay, 48,816 is the closing balance. Now, that closing balance will become the opening balance. Please come here. So, here it will be 48,816. Then, interest again 10%. 4882. Interest 10%. Now, principal repaid 15,400 minus 4882, 10,518 is the principal repaid. Then what is the closing balance? 48,816 minus 10,518, 38,298 is the closing balance at the end of second year. Now come to opening balance at the beginning of third year. Same number, 38,298. Interest 10%, that will be 3830, just rounding off, okay, right. Principal repaid, this will be 15,400 minus 3830, which is 11,570 minus from 38,298, I need to subtract this. If I subtract this from 38,298, I get 26,728. That is the closing balance at the end of third year. That will be the opening balance at the beginning of fourth year. Now, come to year 4 opening balance, that will be 26,728, interest 2673, that is the interest. Then, what is the principal repaid? 15,400 minus 2673, 12,727 is the principal repaid. What is the closing balance? 26,728 minus 12,727, 14,001 is the opening balance, is the closing balance. That will become the opening balance for year 5. 14,001, interest on that will be roughly 1,400, okay, right. Principal repaid technically is the difference between these two, which is around, I'll just write only for rounding off purpose, around 14,001. It's 14,000. I'm just rounding it off for this purpose. So, closing balance is 0. Okay. So, you have some information, the balance you calculated, and you arrived at this table. Now, what is asked in the question? You are required to calculate total interest and interest included in cash installment. Total interest. Can you calculate total interest? Of course. Now, you have interest everywhere, so you can calculate total interest. Calculate 5383 plus 4882 plus 3830 plus 2673 plus 1400. So, total interest is coming to 18,623. Okay, that is the total interest. Okay, right. Now, and interest included in cash installment. In each installment, interest, if you talk about, in first installment this, second installment, third installment, fourth installment, fifth installment. All right, that concludes the problem. Friends, now what we will do is, in this table kind of a manner, we will solve a problem that we already solved. Okay, so I'll read out the question. A acquired on 1st January 2000 a machine under a hire purchase agreement which provides for 5 half-yearly installments of 6,000 each. The first installment being due on 1st July 2000 Assume that applicable rate of interest is 10% per annum. Calculate the cash value of machine. All workings should form part of answer. We already solved this problem where we started with the last installment. We broke that up. We added all that stuff we did. We understood the logic. Okay. Now, in examination, yes, you have to present your logic, but if there are better ways to present your logic, cleaner ways to present your logic, always that is a better state to be in, right? So, now what we will do is, this problem we will present, and in fact solve and present in this table kind of a manner. Just draw this table. What is the interest rate? Interest rate is 10% per annum, but for half year we calculated that as 5%. And it is not annual installment, it is a half yearly installment. Just draw the table. We will start solving this problem once again using this approach. It seems like that Sudoku puzzle that you will be playing here. Oh, these are the numbers that I know. These are the principles based on which I need to plug in the other numbers. You will enjoy this process. Come on, just draw that. We'll start solving the problem. Friends, we have a table where opening balance, interest, of course, I took 5% for half year, then installment principal repaid and closing balance. These are the columns what we have, and half year 1, 2, 3, 4, 5. This is what we have. Now, what's given in the question? We have installment 6,000. That's given. Alright. Now, come to the last installment. It is 6,000. This 6,000 is the installment paid which has principal as well as interest portion. So, this is 105 equivalent. 5 by 105 into 6,000 is 286, which is this interest. Okay. Then principal repaid will be this minus 286, which is 5714. We know closing balance is 0 because at the end of all the loan schedule we should have in closing balance to be 0, otherwise your loan schedule is incomplete. So everything should be paid off. Now opening balance must be 5714. Opening balance of what? Principal value. Principal value is 5714. Okay. If this is the opening balance, closing balance must be 5714. Okay. Right. Listen carefully. After paying 6,000 of installment, closing balance is 5714. Before paying that installment, how much would have been the outstanding balance at the end of the year? At the end of half year 4, what would have been, not year, half year, at the end of half year 4, what would have been the closing balance? 6,000 plus 5714 would have been the outstanding balance before paying 6,000 of installment. Okay, that will be 11,714. Okay, if 11,714 is the amount that is representing 105, what is interest? 11,714 into 5 by 105, which we got as 558. Okay, right. Then we said 6,000 minus 558, 5442 is the principal repaid. Okay, so the opening balance will be sum of these two, because this much we already repaid in this year, this much of principal we are yet to pay. So the opening balance will be 111. So 11,156 is the opening balance. That will be the closing balance for half year 3. Then again you will calculate these two put together would have been the closing balance before making that half yearly payment. Okay, so based on that 11,156. So the calculation would be, I mean rough work, 11,156 plus 6,000. Okay, 5 by 105. You are multiplying this with 5 by 105. That will give you interest of half year 3 as 817. Principal repaid 5183. Based on that, if you add up these two, you will say that is the opening balance of half year 3. That will be 16,339. Then that 16,339 will be the closing balance of half year 2. Again, so total this up, that will be 16,339 plus 6,000, 5 by 105. Okay, that will give us 1063, which will make this 4937. Opening balance, total these two, this will be 21,276. Then 21,276, again 5 by 105 into 21,276 plus 6,000. So which we got as 1299 interest. So that means this will be 4701. Now total these up, 25,977 is the opening balance. So basically we said this is what we are trying to find out in that problem. So you can arrive at that solution in this manner also. But the only thing is, yes, while you may solve this, when you are seeing it for the first time, it will not be obvious because we know the way to solve it in the detailed manner. Now when I am just kind of doing this dance, going from one cell to the other cell, you might feel okay about it, but I suggest you solve the problem, what we already solved in that method, you solve it in that model once, and then you train this model also. You know why? It's not that I'm trying to confuse you with two methods. This is very clean and neat when it comes to presentation. That is very elaborate. Depending on the number of marks for which the question is asked in the examinations, you can decide. If you know both, I mean, if that is like a 8 marks question, maybe you have more time, you can probably do that. If it is like a 4 or 5 marks question, maybe you don't have so much time, then you might quickly add a, kind of use a framework like this so that you are able to present your answer. Choice is yours.